So welcome to all of you to this market Thursday. We are October the 1st. It's 9 p.m. here in London, but you're not necessarily in London. So good evening to you, or good morning, or good afternoon. As usual, I'm going to be starting for those of you who don't know me, because there are always newcomers. I started to trade in 2000. I started in Paris as a cash equity trader and as a fund manager. I know, Kevin, I know. As a cash equity trader from 2000 to 2004. Then in 2004, I arrived in London working for an asset manager called Griffin Capital Management on the long-only product and on the long-short product, where the asset under management went from 150 million to 600 million euro for the Western European team. Then slowly but surely, that was the same for the Eastern European part, where the company was managing 3 billion. Then in 2009, I joined Infinity Capital Markets, where I was a prop trader from 2009 to 2018, running an absolute return mandate with no asset and regions constraint. In 2014, from 2014 to 2017, I was a senior mentor for ITPM. And in 2017, I left. I restarted doing mentoring in 2018. And I launched a year ago, exactly on the 1st of October 2019, I launched the 4x4 video series. So what are we going to do today? Today, as usual, we're going to be starting with looking at the price action. Why is it the sound is working? Yes, sorry, it's just Zoom is a bit of a mess. So we're going to be looking at the situation across asset classes, stocks, credit, commodities, FX. What I would like to do as well is to be looking back in the mirror at Q3 and the performances across asset classes. So that's the typical market review with the recent performances and the next catalyst. Okay, so that's, as always, technical analysis plus price action. As someone was mentioning this week, sometimes you might be struggling, for some of you, with some of the concept, and he was mentioning what is the price action. Price action is about looking at the technicals and trying to identify trends, short-term and mid-terms. So what we would like to do first is to understand how the different asset classes have been behaving recently and how they might be behaving in the near future. And here we're going to be talking mostly about the listed ones, as I said, stocks, credit, commodities, and FX. Then, as usual, we're going to be doing a bit of macro. So today we're going to be doing the ISM Manufacturing, which came out from in the US. After that, we're going to be looking at a bigger catalyst, which is the coming earnings season in the US, which will be starting soon. Then, not only for the noise, but more to look at the US elections and what could be the drivers, and some ID generation based on US elections. This is something that I've done in the past. I want to do a bit more because it's coming in the next 4 to 6 weeks. So that might help some of you to generate IDs. Keeping in mind that my job is not to give you level, it's not to give you investment advice, is trying to give you as much as possible to give you a process. So that is the idea here. And then finally, depending on the time we're going to have, we should be doing a bit of Q&A sessions on questions that you might have on today or on different topics. So first thing first, let's start with the asset classes performances. As always, on the left-hand side, we get the year-to-date, and on the right-hand side, we get the week-to-date. So from last week to yesterday evening, what you can see is the equity market, the stocks have been pretty strong, with the Nasdaq up roughly 5%, the S&P up 4%, If you look at emerging market, India was up 6% in the meantime. That is something that we discussed after very often the sell-off based on the options expiry. This is exactly what happened in June, and as I mentioned last week, after the week of the expiry, after the OPEX, in the next few days, you have a sell-off in the market because people need to initiate new position to hedge themselves. So there is delta coming in the market that is provoking a bit of sell-off. And so on the Monday after the expiry, or Tuesday, Wednesday, people are like, oh, okay, what is happening? So the reasoning is mainly options expiry and the new positioning. So nothing more than that. Since then, the market has been recovering nicely. As I said, we are 33.70 on the S&P. If you look at the currencies, the Aussie dollar is up versus the US dollar by 2% over the last week. Gold is up 1.5% after the recent sell-off. And WTI, which was yesterday at 40, has been struggling today. So it was at 38 before. I think it's around 39 now. But there has been some sell-off based on, as always, supply and demand. Supply going up from the Libya reopening, and demand coming down again because of coronavirus. So again, this is something that we have covered over and over and over. So not new to you guys. So let's look now at the asset class performances in Q3 2020. First hand side on the left in blue, you can see that stocks around the world have been pretty strong, obviously, as always, ex-Europe. So Europe has been flat to down. The FTSE was down 4%. But the Nasdaq is up 11, was up 11, S&P 8.5, and emerging market from China to the EM were up between 6 to 10%. So pretty strong reading in Q3 for risk on across the pond. In terms of currencies, you know now that the US dollar was pretty weak in Q3. Between 2 to 5%, depending on which currency you'll be looking at. That's something that we covered over the previous webinars. Gold was strong, again, despite the sell-off that we had recently from the highs at 2050 to the 1900 now. And WTI, despite being up almost to 45 recently, is now back into the 40, which is like a big magnet. We covered that since June, and we know that many industrials, many countries are hedging a lot of their exposure around 40, meaning that there is a lot of supply coming, and the demand is not that strong yet. Carry on with the year-to-date sector performances on the left-hand side. Energy, pretty is an understatement, very weak. Year-to-date down 50%, but actually followed by financials, which are down 22%. And on the other end of the spectrum, we get technology, which are up almost 27%. So you can see how alpha generation based on sectors, how important that is. If you look at Q3, energy is still the dog. I mean, it's the dog we're going to be covering a bit, and each time we're going to be talking about energy, this is the dog and the dog again. So no surprise. It's something that has not been working, and if you've been trying to catch this falling knife, that has been pretty painful. But what you can see from the Q3 2020 sector's performance is actually technology is not that much outperforming sectors like industrials, which were up 12%, materials almost 13%, or consumer discretionary almost 15%, which tells you that the market in Q3 played quite a lot the US recovery. And that means you've seen 4 to 5 sectors that have been pretty strong. And in terms of alpha generation, we are talking 5 to 6% on the quarter. Again, looking at the other asset classes. So for the new joiners, as there are many today, I like not only to be looking at stocks, even if that's my background, I want to understand what is the picture across asset classes. So I look at bonds, and when we're looking at bonds, we look at bonds in terms of bips, and 100 bips making 1%. So if you think about the US Treasury, that will be trading at, let's say, 70 bips. When it grows from 70 bips to 65 bips, from 0.7% to 0.65, that gives you a differential of 5 bips. So here, instead of week to date, you should be quarter to date. But as you can see, for the US Treasuries, for the gilts, not really moving over the quarter, Q3. But in Europe, for Germany, down 12 bips. Italy was down 50 bips. We know that the ECB has been pretty active at buying the peripheries. More importantly, Italy. So that has been a big mover in the compression of the yields versus the Bund, which is the benchmark for Europe. If we look at the VIX here, which is the implied volatility for the S&P 500. The last is around 25%. Year to date, we started at very low level at around 14%. And again, this is quarter to date. We have been trading down because we were at 28%, but we were way before at the 80s, 90s. So volatility has been coming down. Despite elections coming in the US elections coming in the next few weeks. In terms of winners and losers, I mean, the names that you have for the winners, so you do have like some electrical vehicle with NIO, you get some pain, some gambling, but you can see for the top losers, actually 4 of the 5 top losers have been energy. And only to save you there, you can have a bit of weed to make it a bit less painful. But that is more or less the picture that you have across asset classes. If we carry on, something that I strongly advise you to do, and I strongly advise my mentees to do, is to be looking not only at the sectors, the 11 sectors of the S&P, but looking on an industry level. And similar here, I've done the Q3. You don't have all the sectors. When you do industries, you need to be checking as well what those ETF are holdings, and that can be misleading. But you can see that solar, silver, online retail, those industries have been pretty weak. Again, the losers have been oil services, energy, and the banks. For ID generation, I like looking at this because that helps me massively. I think this is something that we should all be doing. Finally, last week we look quickly. I think it was a stay-at-home index versus the S&P 500. Today, this is the FANG, which is for Facebook, Amazon, Apple, Microsoft, and Google. And as you can see, it has been outperforming massively. This is not new, massively since 2014. But there has been quite a reversal at the start of September, from the 1st of September, on those overplayed, it's easy to say when it's coming down, but that those overstretched sectors and single names, because it's down more than 10% from the top. So that's something to monitor to see if there is a change in the underlying market. As always, now let's jump into the technical analysis. Again, I don't want to be spending too much time, but this is where I would like to be starting. Looking at the S&P as always. So S&P, we are going back into the levels that the resistance, which will be 50 points higher, 1.5%. Again, we had the sell-off based on the options mainly. And since then, we have been recovering. This is exactly something that we had here in June. Okay, so this is the same pattern so far. For the Nasdaq, this is already quite an important level. There is not much between this 11,500 and 900 above. So that could be quick on the S&P. Let's go now into what I wanted to mention today. Yes, so looking at today the CL2, I'm using CL2 because otherwise the CL1 is distorting with the sell-off that we had before. So literally, oil since June has been struggling to go higher, much higher. And it's trading into this range between the 37.44 best, and today was a bad day. I think what was interesting today was the sell-off in copper. So copper for the start of the month was down 5%. So now we are back to levels that we had in August. So I just talked to one of my friends who was a colleague as well, and he showed me an interesting chart between China, not M2, but Chinese credit, and the correlation between Chinese credit and commodities. And actually, if you think that there is a strong level of Chinese credit going into the Chinese economy like it is these days, there is a chance and a strong correlation with commodities going up again. So that is something to monitor. Again, as long as the price action is not going your way, maybe it's about staying on the silent. Euro dollar, something that we have covered recently. That is a very important level here. Bulls, bears, I mean, there is fight here. I look at the Australian dollar, the Aussie, which bounced nicely on this 0.70 roughly. So far, so good. That is holding pretty well. So if we go back into daily, so that's for the currencies. Again, the US 10 years, you can have a look. Nothing is really happening. It's trading sideways between the 50 bips and the 70 bips. Not much happening. DXY kind of trading sideways. I know that some of you are interested in the gold. So we had the sell-off, too many positioning. And again, as we discussed last week, there is a massive correlation. I mean, at least there was massive correlation, inverted correlation between the gold and the dollar. And as the dollar has been weakening a bit over the last 5 sessions, the gold has been strengthening. Something that I really quickly want to mention, if I have it, unfortunately this is not the one. I just wanted to show you some stock that so I look at BABA, for instance. Why? Because I wanted to look at stocks that have a bit of pickup in volume, interesting level. So that was for the breakout. Unfortunately, it didn't cover, and it didn't. Is it there? No, it's not going to be here, unfortunately. But Square as well is going into important level. So if you do technical like this, you can see that 170 is an important level. And you need to monitor those stocks for breakouts. That's something that I covered before. If you get questions, reach me. I might help you on this. Okay. What about we go back into the asset class performances and the PowerPoint. So PowerPoint, the catalyst that I wanted to mention as every week. So here we get the catalyst from Reuters Icon that I'm using. So tomorrow we get inflation in Europe, which is HICP, which stands for Harmonized Index of Consumer Prices. I don't know if you saw, but a couple of days, Lagarde from the ECB said, as always, 2 to 3 months after the Fed, that one was only 1 month, that the ECB might review the mandate, its mandate based on inflation. So you can be sure that what happened a month ago at, where was that? When Powell discussed that in August, about the new mandate of the Fed. It's going to be the same with the ECB, trying to give themselves a bit more flexibility towards inflation, keeping in mind that they are really struggling to reach the 2% inflation. But they're probably going to say, because we had inflation way below 2% for quite a long time, what about we have inflation way above 2% for longer than expected? So tomorrow, a lot of noise, NFP. Why is it important? Because it's just before the election. So you can be sure that one way or another, there's going to be millions of tweets around this NFP. And then we have as well the Michigan confidence. So there was some confidence this week. I think it was the consumer board, pretty strong confidence, but there is a divergence between those two signals. So that's something to monitor. Then on Monday, we get the services PMI, keeping in mind that services PMI have been really struggling versus manufacturing PMI. And on the 6th, we get Australian, the RBA, with possibly changing rates. And this is more or less what we have. I think on the 7th of October, I wrote that down, we get the debate between Mike Pence and Kamala Harris in the US for the vice presidents. So there's going to be a lot of noise as well. And this is mainly about the US election. ISM Manufacturing today. So for those of you who are not very familiar, so we looked at the ISM readings as always, but the ISM readings and any surveys that we had recently was really hard to read. Why? Because when we have Armageddon, as we had in March, April, May, and June, if you ask anyone how it feels versus the previous months, it is extremely hard to read. Nonetheless, ISM, which has a long history, is a very good leading indicator. So for the joiners, the ISM Manufacturing is considered as being the best and one of the most detailed leading indicators. So that's a survey that is based on 300 or more purchasing managers across the US and for 18 industries, based since 1931. So you do have like 90 years of history. And what is interesting is this survey is divided into new orders, production, employment, supply, deliveries, and inventories. So that gives you a full spectrum about how the manufacturing is doing in the US. I know that some of you might think that because manufacturing is only 20% of the US economy versus 80%, that is less relevant. In reality, any economic cycle is stopping when industries and manufacturing are stopping. Why? Because if you think about services, they are all along the value chain of manufacturing. So if manufacturing is struggling, the services will be struggling. So that's a very good leading indicator. Again, the beauty of this ISM Manufacturing, it's an index, diffusion indexes, where you ask people month to month, what is the perception of the evolution of the situation? And here, this is why we have been struggling over the last 6 months. And more importantly, if you have been doing ID generation based only on the ISM, you're probably sitting on your hands and you have been probably struggling. So that's something that I pushed big time with the 4x4 video series. From my experience, I know some of you only do the ISM, and if that's the case, you get little chances. So what I would like to be covering a bit today is a bit more the ISM, how it works, looking at the headline index, the sub-indexes, and how the sectors industries are trading, and finally the industries comments. So I strongly advise you to go, for those of you who don't know, on the website of the ISM, looking at it and trying to get a better feel. So in terms of chart, here, this is the ISM Manufacturing on the left-hand side. This is for the main index. So if you think that about this, normally 50% is obviously the threshold, meaning 50% more people feel better versus the previous months. If you look at the correlation between the ISM and the US GDP, normally, if you don't have Armageddon and kind of everything is changing slowly from one month to another, as long as you are around above 42 on the ISM manufacturing, you have growth for the US GDP. Okay, as you can see, we had the end of the world and then the nice bounce. But again, by definition, if you ask anyone how they feel versus a month ago, most of the time, because we reach very low level, and they feel better. On the new orders, we had really a big drop, a big bounce. But actually, if you look at the new orders from today, which was at 60.2% versus 67.6%, that was obviously a bit less bullish. You can't be into the 70s for too long, or high 60s. But you can see that the ISM manufacturing, even though it is still growing, meaning the US economy is still growing, this is not as strong as it used to be early in the recovery. So when we look at the ISM manufacturing, again, the beauty of the ISM manufacturing is it gives you a lot of details on in terms of sectors and industries. So it gives you which sectors, which industries are performing well and the ones that are struggling. So it's really a good indicator of what is growing and what is in recession. If we look at today's report, what I like, so as you have several sub-indexes, I like to look mainly at the main line, which is the index, and the new orders. Why the new orders? Because the new orders is the leading indicator of this leading indicator. So today on the index, on the positive hand side, we get the food, wood products, and chemical. So wood products have been doing fine for quite a long time. Food, by definition, is defensive. On the negative, guess what? Petroleum, oil is doing pretty badly. Apparel was pretty bad today. Primary metals, not great. And on the new orders, you get paper products, plastic, food, wood, and apparel and textile negative. So what you can see as well from the new orders is that the cyclical sectors like chemical, machinery, plastics are still growing, but less than the previous month. So you remember when we discussed that in July, we started to see really a strong recovery and we wanted to have a follow-up in August. Now September is still okayish, but not as strong as we want to believe if you are bullish a lot. So still growing, but in terms of cyclicality, it is not as good as it was a couple of months ago. Same thing with the comments. Beauty of this report, you look at the comments, I think I picked 3 here. You can have, there were 10 today. And this one is pretty interesting, and that tells you all about XLE and the oil sector. Our business has not begun to recover. So this is still Armageddon, not much to expect at the moment. And this is why, but you can see the correlation with XLE being down 50%, WTI being struggling. If you look at the wood products, that is going hand in hand with what happened to lumber. The lumber futures from July to a couple of weeks ago, where we had impact on the supply because there is so much demand from new houses and housing that there is some shortage somewhere. Meaning as well that if you have exposure to these industries, you should probably be checking the supply chain and checking the possible impact on margins. Finally, wood products, paper products, seeing a good demand. So here, ISM, again, I think now it's a better time to be using ISM than it was a couple of months ago. ID generation should be easier, and from today you should be able to be generating IDs. So that's kind of a message that I'm passing on for my mentees today, that they don't have much excuses not to generate IDs. Second topic of today's webinar, I would like to discuss the earnings season. For me, the earnings season always starts with the JP Morgan. So I always look at when is JP Morgan coming with the earnings, and I know more or less when it's really kicking. So it is starting from Monday the 12th. JP Morgan is on Tuesday the 13th, I think. And here, this is just an example. Sorry for the noise in the background, but this is an example with JP Morgan, where you look at the Q3 expectation, which EPS at $268, 30 billion revenues that you need to compare with Q3 2019, okay, where the actual was at 268. So estimate 245. So that's up. So that's this one. That versus this one. So there is a nice increase for JP Morgan. Again, this is just an example. Try to put in your calendar if you have position or if you have ID in your watch list to know when they are coming with their earnings and revenues, or when the competitors are coming. So what I would like to cover today is what are the expectations coming into this earnings season. So I picked up that from S&P. So this is the operating earnings for Q3 here, expectations. And this is the observation, meaning at the end of March 2019, the market was expecting $48.13, whereas these days we are expecting $32 for the S&P 500 operating earnings. So if you compare the $32 with the $46 from a year ago, you have a differential of minus 31%, okay? And if you compare actually this 30.01 versus what happened a year ago, that is, so if you compare here from 6 months ago, you get $7, which is 20% roughly. So you have expectations that have obviously came down massively since the start of the year and over the last 12 months. But you can see as well since the end of the last quarter, 3 months ago, at the end of June, expectations have been going up, okay? So we're up 6% from 3 months ago. So this is still a massive downgrade from 6 months ago, but less from 3 months ago. So the expectation at $32. So here I picked a bit of comments from Refinitiv, which is more or less the same, which the 20 Q3 earnings are expected to decrease 21% from last year, where excluding the energy sector, the earnings are expected same, down to 23%. So far, we had some constituents from the S&P where 91% have been beating expectation. And here, this is something that is important because that is something a number to keep in mind. Normally, roughly 2/3 of the S&P 500 companies are beating expectations, bottom line and top line, okay? Last quarter, I think we were above 80%. So what happened? We came into Q2 2020, the market participants came into Q2 2020 with very low expectation, and 80 to 90% of the companies managed to beat expectation, and we had from mid-July this massive pump up, okay, of the market. The expectations are still pretty low, but they are lower than they were 3 months ago. Okay, so the question that we be facing now, are we gonna have, like in Q2, as many companies beating expectation as we had in Q2 2020. Here, I'm just looking at the earnings season and looking at the S&P 500 year-on-year earnings growth. Again, same story. Energy is pretty weak. Financials is not that great. Consumer discretionary. So those are all the sectors that have been struggling. And you can see that IT is flat. Is flat on the year. If we go into the next slide, if we go into the revenues, energy same. So before we had the bottom line, here we get the top line, where the consumer discretionary, consumer staples are doing the job of being defensive. Healthcare is doing well. Financials again struggling. And actually, you can see that IT is 1.5%. So it's not as strong as you could expect with the XLK, QQQ, Nasdaq Composite being up that much, but it's more an alpha generation, and market participants have been very keen over since the bottom in March to be paying a premium to any sector, any industry, any stock that is showing a bit of growth. Okay. So earnings season, same thing here. So I wanted to compare and give you a bit more understanding of, looking at the bigger picture, even if we are going just for a quarter here, looking at what happened between 2019 and what are the expectations for 2021. So I try to highlight the winners and the losers, which tells you a lot about how those industry sectors have been behaving. Again, energy, financials in red. You can see energy $16 in 2019, minus 17, plus 10. Financials, we go from plus $43 in 2019 to plus $31 in 2021. So over that period, over those 2 years, if you think that there is a V-shaped recovery over these 2 years between 2019 and 2021, the big losers will be energy and financials. But you can see as well that other sectors that are more cyclical, like industrial, here goes from 35 to 32, materials from 17 to 20. So actually now the market is discounting a V-shaped recovery, because the cyclicals will be more or less back to square one from the end of 2019. And the big winners, the two sectors that are really the winners of those 11 sectors are the healthcare. So healthcare from 55 to 80. So that's a differential of 25, which is quite massive. It's 50%, and we got in dollar terms, IT going from 62 to 81. Okay, so those are the expectations. As we are in October 2020, time is flying, but as investor, you should be looking at 2021 already, what's going to happen and what is the market pricing. And that's the same for your ID generation and building your portfolio. Next one, are you still with me? Everyone? Yeah. So no one is following, maybe. So US elections now. So we had the debate on Tuesday. There was a lot of noise, as always. There are many angry people that jump onto Twitter and say, oh, I want to do this and this. Look, if you're a market participant, it's all about making money. So try to avoid this noise. Here we got predict, and those are the expectations. On the one hand, you can argue that Biden, so this is the blue here, versus the purple from Trump, is leading quite easy. We all know what happened in 2016. So we all need to be extremely careful one way or another. Okay, but this is what is the market is pricing at the moment. So in terms of US elections, this is something that I mentioned since January 2020 for those of you who attended my 2020 predictions, even if that's a big word. So if you have not, maybe you can go on YouTube, my YouTube channel, and looking at 2020 expectations. But what is interesting is trying to see what happened in the past when we had elections in the US. So as you can see, in all cases, which is the one in the middle, most of the time the market. So here we are in October. Okay, so we're here. So most of the time it will go up, but literally what you want to have, if you bull, is this one, which is incumbent party wins. And if you're a bit bearish, or if you get a short exposure, which is here, you want the incumbent party to lose. So that's something that I found. Another one on Twitter. This is more or less the same story. So if you think, based on what happened before, that Trump will lose, there might be some sell-off in the market, and the other way around. As always, this is so well spread now, and I think the market is such this year, trying to destroy anything that happened in the past and all the odds like there is no tomorrow, that we should be taking this with a pinch of salt. But clearly you can see with the red chart here that if the Republicans are winning, this is the chart that we had before. Over the last 5 days and more, yes, there is a massive stimulus. And I think there have been, it's not that I think, at the end of July, we had the end of the stimulus in the US, and since then we had a lot of talks. So if you remember correctly, at the start of August, we had the Democrats saying, we want to be doing 2 trillion, and the Republicans doing no more than 1 trillion. Okay, so if you put everything into perspective, 2 trillion is 10% of the US GDP, which is 20 trillion. 10 is 5%. And now the Republicans kind of feel that they need to do something because the economy is slowing. Not slowing, but the path of the growth is not as strong as before. So they are keen on getting closer to this 2 trillion. So today, for instance, we had a lot of rumors that, this fiscal stimulus is going to be 1.5 to 1.7 trillions. That is 7 to 8%. But you can smell that we are getting closer to a deal one way or another. Anyhow, if after the elections or before a deal is going to happen, I think what is key for these elections is not only who's going to be the president, but if the Democrats win everything. My feeling is, and my understanding is, the market participants really like to have the 2 houses that were divided. If the Democrats win everything, then that might change the story. So just for a bit of telling you not to believe the hype, if you think that you'll be always losing when the Democrats are in charge, this is the average winners and the average losers since 1933 here. So on average, you're going to have 95% with the Democrats, where it's not that strong with the Republicans. And I know that with numbers, you can say, oh, this is the timing, this is not representative. And because, when the Republicans were in charge, they were just inheriting, the past damage from the Democrats. You can give me a lot of reasons, but be careful on people telling you, because of the Democrats, it's going to be the end of the world, or because of the Republicans, blah, blah, blah. So look at the facts. Sometimes go away from Twitter. That might help. And this is why over the last week, I've been pretty quiet on Twitter, because I think the next 4 to 5 weeks is going to be complete garbage, and it's going to be really hard for people to sustain what is going on. So US elections, again, I discussed that before. how to generate ideas. I think there are trades to be done. Easy to say, maybe harder to do, but I've been mentioning that from mid-July, end of July. I think some sector that will be benefit anyhow because of the state of the infrastructure of the US is infrastructure. You can be playing as well depending on who's going to be the winners, the small companies versus the big companies. So this is something that we're going to be covering here. This is Goldman Sachs has been pushing some ideas at the start of this week, and I kind of in line with it. And so I just want to present to you what some of the ideas were. But as well as we discussed in July, and now that we are coming closer to the election, I think this is important. We know that the Trump administration massively cut taxes in 2017 and 2018. So if you look at the EPS of the S&P 500 in 2017, 2018 growth, it looks really, really good, like 25% plus, which was not based on the US economy doing that well, but mostly 50% of the EPS growth was coming from tax cuts. So if Biden and the Democrats will put back some of these taxes, which is one of the things that they are pushing, that might have implication for some sectors, industry, and some companies that benefited from it. So here we get the corporate tax rate by sectors from 2015 to 2019. And I've done the overall and by the 11 sectors of the S&P. So as you can see, the sectors overall massively benefited from this tax cut. That's the same as always as trying to see what could be the impact for the S&P 500 overall earnings per share. So if you take the earnings per share of the S&P at the end of 2019, which was roughly at $160, if you think that the impact could be, let's say, 5%, 160 times 0.05, that gives you $8. So suddenly your 160 goes to 152. And if you use a multiplier of 20, 25, depending, you're going to have a different target. You might have a different target for the S&P. Okay, so that's, as always, you start with the S&P 500. And here, what is interesting is to look on the sector level. And how and what could be the trades that could be generated. If you look at utilities, they've massively benefited from these tax cuts to the extent of 15%. So if the Democrats are back in play and Biden is winning, the trade might be XLU, long SPY, short XLU. Because that could be one of the sector that could be suffering. So go through this data after if you want to look. So I will put normally the webinar on YouTube and you can have a look again. On the company level, this is interesting as well. So either you collect data from several websites or you have access to Icon, to Bloomberg, whatever. Is trying to understand the effective tax rate of this company. So when I've done it in July, you can see how a company like AT&T, which is the first one, which used to be paying 32 to 35% effective tax rate, is now paying around 19%. Okay, so that's a huge difference. If you look at Intel, again, benefited massively. 26% to 12%. So Intel, Apple, Berkshire, Verizon. So really, not only the utilities, but the telco companies benefited massively. So for me, if Biden is winning, I might think, okay, what about telco is a good short, and some of those names are good shorts. Again, it's about being ready, trying to have a global themes. My view has always been, when you're running a portfolio in prop trading, in hedge fund for yourself, you need to be generating ideas from your top down, your bottom up, and so global themes. This is the case here. and making sure that you are ready to pull the trigger if you see something happening. So that is for the corporate tax rate here. And I think what similar to what I was saying in July, Goldman Sachs came this week with the idea of what they like to do is to create what they called an index of an ID. And the idea here is to be playing Trump winning again the election. And if Trump is winning the election again, what they do is they build for you some kind of a ETF or basket of stocks where they're going to be putting some overweight and some underweight. So overweight will be obviously if Trump is winning infrastructure, but I think this is the same if the Democrats are winning. Pushing as well for small business, because why small business? Because he's going to be pushing again America first, meaning the Russell 2000 could be the play, deregulation more and helping the mega banks and helping the upper hand of the incomes in the US, which could be luxury. On the other hand, the basket short will be made of China, ex-semiconductors, which have been on fire, the green energy, saying, they might not be necessarily 100% for renewables, and as well Affordable Care Act policy change. So for you, the idea is trying to build the same kind of basket. So if you think about doing a basket, it's easy to do. You can be doing, let's say 40%. So if you take a $10,000 position and you say my $10,000 position is Trump is going to be winning. Or when I say $10,000, let's say 10% of your book into one position. You say, what about I put 4% long ETF infrastructure, 3% long ETF small business, which is Russell 2000, another, let's say 2% mega banks, and another 2% luxury, either one name or one ETF. The beauty of now managing a book versus when I started is you have ETF almost everywhere. So you can be building those IDs, not necessarily having a company-specific risk by buying single names, but you can do that with ETF. I like this idea, depending, and the idea is not to take a stance and saying, look, I want Trump to win, I want Biden to win. It's just based on what you expect, trying to build an idea, keeping in mind that you want to do alpha generation. So you don't want necessarily to have like massive exposure. You just think that in terms of alpha generation, by being long, the one on the left, and short on the one on the right, you should be having a good return. So that was for the third ID today. Let me quickly introduce for the new people what I can offer and where I can help you. So this is first with the 4x4 video series. As I said, today is my birthday for the 4x4 video series because I launched the product exactly a year ago. So kind of happy birthday. I have more and more people joining. Yesterday I had 2 people joining, so good thing, and thanks to them. Thank you to them. With the 4x4, really what I wanted to build is a comprehensive investment process where you're going to get 40 videos with around 30 hours of footage or a bit more, 50 plus Excel spreadsheet. And as I've done today, what I would love for you to be able to do, like I did when I was working for hedge fund in prop trading, when I started in Paris, is trying to generate ideas mainly through 4 filters: top-down, bottom-up, special situation, and active trading. So today we've done a bit of top-down. We have done a bit more of global themes, but that's what I strongly want you to do. And as well, what I want to be helping you is building your infrastructure. So You're going to have 50 Excel spreadsheet where you're going to have all the sources. Literally, I want you at the end of the 4x4 video series to be very independent and not be relying on paying anything stupid. Second part is the mentoring program. So the mentoring program is either for people that have done the 4x4, or people that want to have an extra knowledge and an extra push in building their portfolio. This is 12 weekly one-on-one online sessions on Skype, where we're going to be sharing screens. You're going to be managing your own money, your own portfolio, and I'm going to help you doing the different phases of the process, quantitative, qualitative, ID generation, price action, and risk management. That works really, really well. I enjoy doing it. This is something that I like doing. This is what I like to be doing at the moment. And as I said to people, that might change in the near future, or let's say in 3 to 6 months. So, more or less that will help you either to build your track record if you want to have access to the industry, or, which is a good way, a good thing as well, managing your own money to grow your personal wealth. So I offer 2 ways for the 4x4 video series, either 2 months or 1 year. And I offer as well the mentoring program. As I said, if you want to have access to mentoring plus the 4x4, there is a discount that I offer. I'm happy to have Skype calls with people on the 4x4 or the mentoring. I understand that because of the budget that you will have to dedicate, you will like to, you might have some questions. This is what I did this week with 2 persons. As I said, they subscribed yesterday. Thank you to them. That was a nice birthday present for the 4x4. So don't hesitate to contact me. This is part of the game. And we can have a Skype session if you would like to. What about we jump in the Q&A session? I just have one request from you, is if you like what I do, and we are in the world where everything is online and digital, but the algos of Google, of LinkedIn, all those things are smelling and sniffing things. So if you like what I do, please try to retweet, like all these things, not necessarily for the vanity and saying, oh, look how great I am, but more trying to get a bit of traction, because I'm putting a lot of efforts to help you guys here. But if on top of that, I have some traction, that will be even better. What about we go into the Q&A session? So Angus, you got a question. Do you think that there are some really good opportunities in emerging markets due to weaker dollar? I'm thinking fintech, namely like Meli, for example. So Meli, I think this is the Brazilian story, right? Look, those stocks have been, I think what people are really, so emerging market first thing, and Angus, I've been extremely wrong, because I thought that emerging will be suffering from the stronger dollar and from the end of the world, and emerging market EM is back to 43, 45. So I think, you need to be careful with emerging markets. Why? Because they still printed a lot of debt in US dollar, and they will have to repay back these bonds at one stage. And if the growth is not coming back, they might be struggling. If you look at the growth expectation, they are way above developed countries, which makes sense. But we still don't know if there might be a second wave of defaults based on those bonds. But yes, Meli and some other names are some good names. Again, I'll be maybe a bit careful, because it feels like, people are really overpaying those 60 to 100 names. So if you do a filtering all of you US universe, let's say 2,000 stocks, and you do filtering based on top line and bottom line, let's say 25% plus sales growth, and you even don't look at the EPS growth, because you say, okay, what matters at the moment is only the top line. you can see that all those stocks have been on a tear. So far, people don't look at the bottom line, and it's similar to when I started to work in 2000. I remember when I wanted to do a third degree, the question was like how to do the valuation, and the valuation was like people at that time were not looking at the bottom line. They were just saying, it's all about the top line. At one stage, you'll have to, if you don't have free cash flow generation, if you don't have EPS, and it's not covering the return on equity, then this is an issue. So we know that people are going for the same ideas, and it's overcrowded. So far, so good. Everything has been pushed by options, by retail traders, but it's not because it's going up and I'm wrong that you still need to be careful. But Melly is a name that is clearly one of the names that is screening. What else do we have? Which question do we have? How do you calculate a price target for a stock? So that's a question from Thorsten. So Thorsten, normally when you start as an analyst and when you start in a hedge fund, I remember in 2004, when I sat in a hedge fund, I had to do a discounted cash flow model. Okay, so discounted cash flow model is you took the top line and you go to the bottom line and you look at the EPS and you do 2021, 2022, 2023, 2024, 2025, and you discount everything and you discount as well the end value. Okay, so the end value, you're kind of pretending you put a value. So everything is like you guessing, and versus that, you say, I got a valuation, I put the debt, and against that, I divide by the number of shares, and that gives me a target. So imagine how to do it when you have a target price of companies where the expectations, you don't know what's going to happen in 3 to 6 months. So, I mean, that is not that obvious. What I try to do is when I do the mentoring, when I do the 4x4, is trying to understand what is the quantitative, what is the qualitative, how you pay for the management, how you pay versus the competition, how the market is gonna go. So if you think about businesses, now these days you have businesses where you are paying probably metrics not on 2021, 2022, you are paying 2025. So for me, if you pay something so much down the line, you need to know the end size of the market. So that is something that is not obvious. A price target, you need to have, you're going to have a range of price target. Okay. My job is not to be an analyst either. So I'm not going to be spending, hours and hours looking at models. Angus, do you think that the S&P 500 will ever be able to return back to a normal P of 15 with interest so low? So yes, if you look at the average P, which is at 15 times, now we get a how do you say that, a Japanification of the world. Okay, so everything is at 0%. So by definition, the PE is going higher because the discount that you're using is at 0 for longer than I think what's going to happen is if you give me a lot of money and I spend, I might be feeling good for 6 months, 12 months, 18 months, 24 months, but at one stage I will have to pay back. So I don't know when it's going to happen. Clearly the market since 2019, so if you look at 2019, there is no earnings growth or barely no earnings growth for the S&P. So we were up 3 to 5% earnings growth. I think it was 4.5% something. But in the meantime, the market went up 35%. Not only because we had a sell-off in 2018, but because the rates were expected massively, Fed funds expectations came down massively. So we went from, I think it was 125 bips up to 125 bips down. So huge changes, which explain the PE going from 16 times to 20 times. What do you think about carry strategy, shorting out of the money front months puts and shorting futures in for October? So shorting out of the money front months puts and shorting futures. I got a theory that I don't like to be short options. Okay. Each time I saw someone completely blowing up was when they went short options. Each time. Okay. And because it's kind of saying, you know, I got a strong conviction and it's so out of the money, so I'm fine. So be careful with options. I think the best way for me is what is the risk reward. So you put on an Excel spreadsheet, okay, what is the worst case scenario first? Each time my mentee is coming with an idea, I asked them, you know, what could go wrong, okay? And what's the worst case scenario? And what's the worst case scenario is in here, that will be in terms of P&L, okay? What else do we have? Do we have anything else, or we all good for today? We're good for today. Let me take a last one. Then. So from James, is the rebalancing effect you mentioned last time pronounced across specific stock sectors as well as between stocks and bonds? Do you hedge volatility with option structures such as VIX, puts, calls? I think the rebalancing is more on the broad-based spectrum, meaning that it's more, you know, on the index level, less on the sector or industry level. For hedging yourself with options, yes, I don't do much VIX put calls, even if I'm more and more tempted to do it. These days, I'm struggling with the level of implied volatility, okay, because I know that the implied volatility is massively distorted, as we covered before, by the number of the weekly calls options more. Okay, so I know that I might be overpaying implied volatility. So if you think about the last couple of months, the market has been pretty quiet, even if we had a sell-off. I mean, when I say quiet is the wrong word, but is it worth a 25 to 30% implied vol? Probably not. Okay, so the realized volatility was much lower before the sell-off. Okay, so I know that if I go long volatility, yes, again it might go higher, but I'm already entering the market with a pretty high implied volatility level. So when you do VIX called put, I think you need to be, it's more like you're a sniper and you say, okay, I think in the next 5 days, there's going to be a shoot up in the volatility. So I play it. Okay, so that will be like playing the VXX before, where you know that you're going to be destroyed with the rolling of the contract, but you're playing on the 1 to 5 days just to play the short-term move. Okay. Last one from Angus, and that will be the last one for us. Do you think FANG are the new utilities defensive in this new normal economy? I mean, what safer place to put your money? There was a really good book. What was the book? Where is this book? Which was on concentration in the US. Okay, so Angus, if you think about what happened over the last 10 years, is the big companies in the US and in the world are now massive. So if you think about Google, if you think about Amazon, if you think about Apple, they are making, you know, they got market share between 50 and 80%. If you think about capitalism, capitalism works well as well if you limit the size of the winners, because otherwise there is no room for the small players or for the new proposition to grow. And I think what's going to happen, even if we benefited massively from Google, from Amazon, from blah, blah, now we're reaching a level, and the regulators in the US has not been doing his job for the last 10 years. Okay, now they will have to jump and say, you are too big. What about you open the doors to competition? So I think for me, I mean, if you look at the free cash flow generation of those companies, of Facebook, Amazon, Microsoft, Google, it's just insane. I mean, it's absolutely insane. They are printing money like there is no tomorrow. So that's normal that for those names, you'll be paying 30 times earnings, 40 times earnings, because they are really printing money. And the free cash flow generation is based on billions of sales. And those billions of sales are not growing 1, 2, 3% like the US GDP. They are going 10% plus. So there is, it's not only the narrative, there is a good underlying behind it. But I think, and maybe call me a bit of a socialist here, but I think those players are too big, okay? And the regulators need to jump in. Why? Because it's not benefiting the consumer anymore the way it was benefiting, the consumer was benefiting from it. I give you an example. If you look about Microsoft, so 10 years ago, when you were buying a computer, you are buying Microsoft and you get the license for the time of the computer, okay? Whereas these days, if you buy a computer, every year you need to spend between $70 and $100 buying your Microsoft Windows. I mean, that means that instead of paying 100 times once, now every year you're paying 100, meaning that they multiply their revenues by 5 to 10 times. What about the regulator say at one stage, first, Microsoft is too big, it's too big because this is a monopoly, and actually offering the services doesn't work. And I think here, I don't have the time, this is the limit. I think everyone was pushing for these names, and this is why I wanted to put this chart. We had the sell-off that started on the 1st of May. There is so much hot money into those names that everyone is playing those 5, 10 names plus those 30 to 50 names that are, you know, all the same every day. The Tesla, this AMD. I mean, look, again, we are all chasing growth, okay? It's hard to get visibility, and that means you're going to be playing a premium for those companies. Kevin, finally, I'm not sure about the Lulu. Finally, I didn't mention that when I was talking about the 4x4 and the mentoring. Recently, I've been approached by ex-mentees and people that have done the 4x4 about doing a product where it will be to do roughly 10 sessions over 4 to 6 weeks, where we'll be trying to do 2 sessions per week. And those 2 sessions per week, I'm targeting to have at least 5 to 10 people, okay? 5 to 10 people that either have done the 4x4 or the mentoring and want to do some follow-up. And half of the session will be similar to this one presentation, talking about what is happening to the market. And then we're going to be doing, each time we're going to be doing a case. And the case could be top-down, bottom-up special situation, and you'll be coming with your idea. So bottom line is, if you are interested, please contact me. I do have a start of interest from some people. I don't want to do this only for a few people. Why? Because I think it's good as well to be creating some connection between you guys, as you have been asking me to build a community. So if we do that, maybe we could be targeting November. So reach me, send me an email, a Skype, a tweet, well, whatever. There is interest. For the pricing, for everything, that is something that is pretty open at the moment. I'm just trying to evaluate what could be, if you could be interested. Okay. As always, I hope it helped. I will do the same normally next week. If you have questions about markets, mentoring, 4x4, don't be shy. Send me an email. There is no stupid questions. I realized that this week the new 4x4 subscribers were sometimes struggling when I was doing the webinars. I try to do something as easy to understand as possible. Having said that, you know, that is sometimes not the case. So if you have question, again, there is no, don't be shy is a bad word, but please feel free to reach me. These days I enjoy doing it. I might be back to trading in the next few months, so maybe this is the time to do it. Thank you very much. Talk to you soon, all of you. Bye-bye.